I know you have a lot of biotech exposure. Just coincidentally, the company going public right now, all that noise while Jenny was trying to get her point out, a biotech company going public just now. You have a lot of biotech exposure. Joe's talked a lot about biotech. Is that the place to go, considering some of this turbulence we're seeing in the market?
Well, it's been a great story, obviously, year to date, Frank. You know, XBI is up, I think, 20%. The IBB, which I have exposure to, is up around 19%. I think part of that has been a bit of the rate story. And yes, I mean, I don't look at biotech as quality, right? There's a lot of unprofitable companies in that space, but I think it's part of the interest rate story, which we knew what was going to happen in October. The December cut is a little bit more gloomy now, potentially only 60% potential of a cut. But what we were starting to talk about is the earnings picture, right? So it's an 83% beat rate.
17% higher year over year.
You got it. In aggregate, the earnings growth rate is now, because we've heard from the tech guys and the tech companies, almost 11% growth rate. We came into the quarter at 8.8%. Atlanta Fed is at 4%. So there's a lot of good things in there. But one of the things I wanted to mention in terms of seasonality, I remember sitting on this desk in August and early September, and we were talking about seasonals and what that was going to look like. September, S&P was up 3.5%. October, the S&P was up 2.3%. For me, it's a bit of digestion. I think this is also a valuation story, not just valuation compression, not capitulation. So that's really been my story, kind of as I view and look at the frothy parts versus other parts of the market where there's some more quality.
Right. Bryn, coming over to you. I mean, we're talking about all these different issues. I do want to get back to earnings season. We just got the latest numbers from LSEG. Q3 earnings up 17% year over year. Very strong earnings. A lot of people say earnings drive markets. So despite the last few days of some difficulty and some sell-offs in tech and unwind of momentum that Joe's been talking about, are we maybe making too much of all this?
So in regards to earnings driving returns, there's actually very little correlation in the short term that earnings drive a particular stock or a market. It's really over long periods of time. And so the direction that earnings, I want to see year over year, we'll probably end the year with about a 7 to 8% growth rate in earnings. So that direction is positive for this high valuation that we have in the market cap, whether it's the NASDAQ or the S&P. I think, though, with some of these individual names, I think to Joe's original point about momentum, maybe it's like slowly than all at once. You definitely see that shifting. And I know we'll talk about maybe Robinhood later, but you can have a company with great numbers. But if you're up 250% for the year, you cannot expect not to have drawdowns. And I do believe that I can speak for myself. I have like a big hangover from all of these Jensen, Sam Altman announcements. It's just like enough already. Just like keep your head down, go back to work. But these announcements to me are the new meme stocks. And I think that, Oracle, I think, is the poster child of this really crazy, outlandish announcement that neither company has the ability to pay for. And I do think it's like when the market does have these pullback, to me, it's a little bit sign of a healthy perspective, because we can't just continue to have these meme moves in these partnerships that, to me, we'll see if they actually happen and what actually goes on. So I think earnings are intact. We're going to get rate cuts. We will be stimulative next year with the OBBB going into effect. And so I think we're just having a correction. And I do think this government shutdown, the longer it lasts, the worse it's going to be for the market.
Bryn, you just mentioned Robinhood. I know you and Joe, you both own the company, or Joe has in the Joe T. Company beat on earnings, very strong earnings, and then it trades lower. It's moving lower today. Is that indicative of just a momentum unwind? Is that indicative of investors feeling exhaustion somewhere? What do you think? I mean, look at this stock. It's down 9% right now.
I think it's a little bit of both, right? They do have a new CFO. This man, Shiv, who's been there for 7 years, is stepping in. I don't think that's why it's down 9%. The numbers were incredible. The prediction markets alone generated now $100 million. And so I think the stock's up, Joe can correct me, around 230% for the year. And so you have a great number, but then you go back to, is it just priced in? Is it priced in? And so let the stock pull back, look at technicals, and I feel confident investors will step back in once the company, the stock itself, finds its footing technically.
It's up 246% on the year, consistent with Bryn's remarks. Think about that. It's down 9.3% today, and it's just breaking below the 50-day.
Okay, and
so that shows
60
you
times
how
earnings.
So that shows you just how much the stock has actually levitated. And I think we're in the process throughout the entire momentum universe where we've seen the strength of so many winners, we're in the process, whether you want to cite valuation, whether you want to cite sentiment or positioning, pick your catalyst. But it's very clear the market right now wants to work off each of those extreme conditions. Overvaluation, extreme bullishness.
So I know you own DoorDash,
long
too.
Positioning.
Same story there?
Dash, absolutely. Look, so
the consumer's weak.
So in the case of Dash, first of all, what's important about Dash is where exactly are you long? This is not about being right or being wrong. This is about managing the risk. So we added this trade into the ETF in April at 192. We still stand with a winning position. That doesn't mean I would suggest to you that you buy it here today if you don't own it. I don't think that's exactly what you do. When you look at the earnings, food delivery was strong. EPS up 44%, revenue up 27%, total orders up 25%. What's the problem? They said they're going to spend several $100 million more in 26 than 25. Okay, when you are, quote unquote, one of the momentum VIPs for 2025, you can't say that and not expect to get punished. So it's about how do you manage the risk in the position. For us, we have a winning position that potentially looks like it could turn into a losing position. We will manage that accordingly at the next rebalance. For those of you out there, it's not a matter of I was right, I was wrong, and pointing fingers about it. It's about manage the risk. So anything that you have bought above today's price, you have to deal with that. You have to accept that you were wrong, and you have to manage the risk, and you have to reduce your exposure there, because this is a name that's not going to reverse and move higher very quickly. It's a name that over the course of the last 6 months I've talked about as it went up to 285. So obviously on the way up, I was wrong when I was saying at 230, I think the stock continues to work and moves higher. Okay, I'm wrong. Well, what do? You manage the risk. You have to take action when these stocks to begin to reverse. And the only thing that we can do is take action at the next quarterly rebalance, and I can assure you that we will. But if you're sitting with the stock today and you don't own it, wouldn't touch it here. If you're sitting with the stock and you bought it higher, you have to take action, manage the reduce the exposure. If you're long the stock at a lower level, like we are, and you have the ability to do something, you want to manage the risk, do that accordingly.
Is there a level that looks attractive right now? Obviously at 201 a share after a big pullback, 15%.
No one knows that. You can't. I don't think when momentum reverses, look, on the upside, how high is high and how low is low? When stocks are moving higher, right? When stocks are moving higher and continue to defy gravity and move higher, you can't say, oh, this is the point at which it's going to stop. Stop.
Okay.
You could say to yourself, from a valuation perspective, I'm not comfortable here if I measure the risk versus reward. I think that's a great way to approach it. On the downside, again, it's the risk to the reward, which is important. And no one could say, okay, 180 is where it's going to bottom. No one knows that.